Okay, let's unpack this. Today, we're diving into a deep dive on a financial concept, well, a life concept, really, that sounds completely counterintuitive.
Hmm.
The idea that success, whether it's in business, art, investing, it often doesn't come from being right consistently.
Right. Not the high batting average we expect.
Exactly. It comes from a tiny number of spectacular results. It's this long tail phenomena. And it really runs contrary to everything we're usually taught about needing, like a high, reliable success rate.
Well, what's fascinating here is how fundamentally this idea challenges our deepest assumptions. From
Yeah.
childhood, we're measured by our average performance.
Yeah. Test scores, quarterly reviews.
Precisely. We expect success to look like that high average. But the data, it proves that in the world of venture capital, major public companies, high-stakes art, the math actually dictates you can be wrong half the time. Sometimes way more, like 90% of the time.
And still end up successful.
And still end up wildly successful. This principle, it sort of quietly governs huge swaths of the global economy. And our mission, I think, is to understand why we constantly underestimate its power.
That sets a really powerful, almost paradoxical expectation, doesn't it? So our mission today is to look at evidence across the board.
Okay.
From like high culture art collection to the dramatic financial turnaround of Disney studios, and then really get into the cold, hard data of VC and public stocks.
Yeah, the number.
To prove this counterintuitive math, because this isn't just some like abstract theory of probability, right?
Not at all.
It's more like the actual operating system for how financial success happens.
Yeah.
We need to internalize this idea that failure, well, it's not the opposite of success in this system.
No, failure is simply the prerequisite. That's a great way to put it.
Yeah.
Exactly. When we talk about long tails, we mean those farthest ends of a statistical distribution of outcomes, right? In finance, where returns can be asymmetric.
Meaning you can only lose 100%, but gains can be,
well,
huge, infinite, theoretically.
Right. That asymmetry means a small number of events or investments can account for the overwhelming majority of all the outcomes. That's what makes the tail so incredibly influential.
Okay, so let's start somewhere maybe a bit surprising. To make this concrete, relatable before we hit the dense financial figures.
Sounds good. Where are we starting?
Let's talk about the story of an art collector, Heinz Berggruen. Now, he wasn't born into wealth or some artistic dynasty.
No, quite the opposite, really.
He fled Nazi Germany in 1936, came to the U.S., studied literature at UC Berkeley. The sources paint him as, a man of culture, curiosity, but certainly not some financial genius right out of the gate.
Yet by the 1990s, he had built, well, by any measure, one of the most important private art collections in the world. We're talking massive holdings of 20th century masters.
Like who?
Oh, Picasso's, Braque's, Klee's, Matisse's. The scale of the collection was just astounding. And then, in the year 2000, Berggruen sold part of his life's work to the German government for a staggering sum, over 100 million euros.
Okay, 100 million euros sounds like a lot.
It is, but here's the thing. The price was so advantageous to the German state that it was functionally considered a donation. Because, crucially, private market estimates at the time valued the total collection at well over $1 billion.
$1 billion?
Yeah.
In masterpieces.
Yeah.
Accumulated over a lifetime. The natural inclination is to say, wow, he must have had perfect taste.
Right. Infallible foresight.
Yeah. Art is famously subjective.
Yeah.
How could one person predict what would become the most sought-after works of the century? Was he just a genius picker? Did he just know?
Well, the investment firm Horizon Research looked into collectors like Berggruen, and they offered a really crucial insight, especially for investors.
Which was?
The great collectors operated essentially like index fund managers, not really like stock pickers.
Huh. Indexing art, how does that work?
They didn't try to identify just one or two perfect pieces. They bought vast quantities of art. They operated on the assumption that only a few pieces would eventually matter financially. They bought portfolios of artists, different styles, and importantly, they held them.
Okay, so this is where the long tail principle really kicks in, isn't it?
Exactly.
If you buy works by 100 artists, and maybe 95 of them end up being worth basically what you paid, maybe even less.
Which happens all the time in art.
Right. The key insight is that the massive appreciation of those 5 superstars, the Picassos in this case, it doesn't just make up for the 95 duds.
No, it pays for the entire enterprise many, many times over. That's the power of the tail.
Wow. Think about the psychological commitment needed for that strategy, though.
Oh, absolutely. Berggruen might have acquired hundreds, maybe thousands of works throughout his career. Imagine the pressure of holding all that inventory, stuff that isn't appreciating, maybe even losing value on paper for years, decades even.
Yeah, most people would crack, they'd sell the losers.
Exactly. So the success wasn't because he had like a 90% hit rate on his individual buys. Maybe 99% of those acquisitions turned out to be of little financial consequence.
But it just didn't matter.
It didn't matter at all because
Yeah.
that tiny 1% that were the seminal pieces, the Picassos, the Matisses, they were so stupendously valuable that they drove the entire billion-dollar outcome. He was wrong most of the time.
And still ended up stupendously right. He basically indexed the art world, accepted the low probability of success on any single item, but guaranteed exposure to the tails.
That's it. And that takes us really seamlessly into the creative world of film, another field where success is incredibly skewed, and where the sources really highlight the painful reality before the tale emerged.
You're talking about Walt Disney.
Exactly. Look at the early days of Walt Disney. Yes, Steamboat Willie was a huge leap technologically, culturally, but financial success, that was a whole different story.
His first studio went bankrupt, right? Laugh-O-Gram.
Went bankrupt. His short animated films were incredibly expensive to produce back then, and often the financing terms he managed to get were described as just outrageous. He was constantly near the brink of collapse.
And by the mid-1930s, Disney had produced hundreds of pieces of content, over 400 cartoons.
Yeah, tons of them.
These shorts, Mickey Mouse, Donald Duck, Goofy, they were beloved cultural phenomena. They were famous.
Absolutely famous. Household names.
Yet the sources are crystal clear. Most of them lost a fortune in business terms.
Yeah.
Popularity did not equal profitability back then. The company was just drowning in debt, financed by short-term loans.
And then came the tail event, the investment that almost broke the company, but instead, it made it.
Snow White and the Seven Dwarfs.
Snow White. Walt Disney mortgaged everything he had to produce that film, borrowed against his life insurance, apparently. It was this massive gamble on a feature-length cartoon, something no one had successfully done before.
And the risk paid off. Big time. The $8 million it earned in just the first 6 months of 1938, that was astronomically higher than anything the company had earned before, right? An order of magnitude shift.
Absolutely. That single 83-minute film completely transformed Disney Studios. It acted as this massive financial injection.
What did it do?
It paid off all the company debts. Imagine lifting that huge weight. It provided key employee retention bonuses, keeping the talent happy, and crucially, it funded the purchase and construction of a new, state-of-the-art studio in Burbank,
Where the company still is today.
where it remains today. The success of Snow White was essentially the sole financial engine that propelled Disney. Took it from being this famous but debt-ridden production house into a financially sustainable empire.
So, out of hundreds of hours of early content, those 83 minutes of Snow White were, in pure business terms, kind of all that mattered for the studio's long-term survival and success.
Pretty much. It's the pattern emerging again, the necessity of hundreds of failures, financial, creative, whatever, to find that one masterpiece.
It confirms that initial idea.
Yeah.
Anything that's huge, profitable, famous, influential, it's the result of a tail event, an outlier, a one in thousands kind of thing.
And because most of what we pay attention to, the enduring art, the massive companies, the hit movies, are, by definition, the results of the tail.
We only see the winners.
Exactly. It's easy to look at them and overestimate the required success rate. We see the finished product, the Snow White, the Picasso, and we assume the process must have been clean, efficient, maybe even easy.
Okay, let's see if that beautiful kind of creative chaos actually maps onto the cold, hard world of financial data.
Right. This brings us to the core investment data. And here, we really need to emphasize that this dynamic where a few wins cover countless failures, it's not an anomaly. It is the normal state of affairs in finance.
Normal for things to fail.
Absolutely. In fact, if your portfolio doesn't contain a significant number of failures, you are likely not taking enough risk to capture that potential tail. This reality should fundamentally shift our expectation, your expectation, of what normal performance even looks like.
Okay, let's unpack the venture capital model first, because that industry openly acknowledges this, right? It's basically structured around the tail.
Completely. Correlation Ventures crunched data on, get this, more than 21,000 venture financings between 2004 and 2014.
Wow, that's a lot of deals.
It is, and the results just validate the extreme skew we've been discussing. They found that 65% of those investments simply lost money.
65%, just gone.
Gone. That's almost 2/3 of professionally vetted deals failing outright. Now, If I told you on this show that most of your investments would probably fail, you'd think I was trying to scare you, right?
Yeah, or that you were a terrible advisor.
Exactly. But for VCs, this is just Tuesday. It's the cost of doing business.
But wait, if 65% fail, I mean, aren't VCs supposed to be good at picking winners? How is that high failure rate even sustainable? Does it just mean luck plays a bigger role than skill?
That's the intellectual tension that makes this so fascinating. The skill isn't necessarily in avoiding failure. Maybe it can't be avoided at that rate.
So the skill is?
The skill is in portfolio construction and in identifying the specific types of companies, usually in sectors like software or platform tech where that potentially infinite scalability is possible. They know 65% will probably fail, but they intentionally invest in companies whose potential ceiling isn't 2x or 3x, but 100x, maybe 1,000x return.
They're explicitly seeking that asymmetric payoff. Maximize the upside potential.
Precisely. And to illustrate the long tail's power here, look at the distribution of the winners in that study. Only 2.5% made returns between 10 and 20 times their initial investment.
Okay, still good, but rare.
Very rare. And only 1% made more than 20 times the return.
1%.
But here's the punchline. The thing that drives the entire industry, the reason trillions of dollars flow into VC funds.
Yeah.
The majority of the industry's entire returns came from a tiny sliver. 0.5% of those companies, only about 100 companies out of 21,000. And these were the ones that earned 50 times their investment or more.
50x.
Yeah.
More. From 0.5% of the deals. That's extreme.
It is extreme.
Yeah.
This is the mechanism. You ask how it's sustainable. It's because of that 50x potential. Why 50x? It's often driven by network effects, modern scalability. When a company, usually a tech platform, hits that dominant market share.
Its costs stay relatively fixed, but revenue just explodes globally.
Exactly. The successful ones don't just grow twice as fast as average. They grow 10 times faster, 20 times faster. They operate in these winner-take-all or winner-take-most environments. VC is the textbook example of an industry where success depends entirely on maximizing exposure to that infinitesimal chance of hitting a 50x or 100x return.
Okay, that makes sense for high-risk startups. But, the common wisdom is if you want safer, more predictable returns, you move away from VC. You invest in large public companies, blue chips, the big guys on the stock market. Surely the big public indices aren't dominated by the same extreme skew.
Well, this is where it gets really interesting, because the tail, it seems to drive pretty much everything, including the distribution of success among large public stocks over time. The distribution looks remarkably similar to venture capital.
Really? Even with established companies?
Even with established companies. Most public companies, over the long haul, are eventually duds. A few do okay, and a handful become those extraordinary winners that account for the overwhelming majority of the market's overall returns.
Okay, let's look at the hard data then. JP Morgan Asset Management looked at the Russell 3000 Index. That's a huge, broad collection of public companies, right?
Massive index, captures most of the U.S. market.
And they looked at it since 1980. So 4 decades of data. What do they find? This is kind of shocking.
The sources show this incredible statistic. 40% of all Russell 3000 stock components lost at least 70% of their value and never recovered over that period.
40%. Let that sink in.
Yeah.
Almost 4 out of every 10 established public companies in a major index companies that have already proven they can operate at scale get listed.
Are effectively catastrophic losses for long-term investors. They lose almost everything and never come back.
That 40% failure rate, it really should redefine what we think normal risk is in the stock market. It means if you own, say, 10 stocks that picked randomly from the index, expecting 4 of them to basically fail.
Yeah.
That's not pessimism.
No, it's just statistical reality based on decades of data. And yet, despite that overwhelming failure rate,
the Russell 3000 Index overall has increased more than 73-fold since 1980.
73-fold.
How can that be? Massive failure rates,
Yeah.
yet spectacular overall success.
Compounding, and the long tail again. Effectively, all of those spectacular index returns came from just 7% of the component companies.
Only 7% drove almost all the gains.
Pretty much. And these were the companies that outperformed significantly. And when we say significantly, the data specifies these companies exceeded the average return by at least 2 standard deviations.
Okay, let's pause there for a sec. 2 standard deviations. That sounds technical. Could you conversationalize that for us? What does that really mean?
Yeah, sure. Think of 2 standard deviations as meaning these returns are way, way out on the statistical curve. They are truly exceptional outliers. It's like finding a unicorn in your portfolio.
Okay.
These aren't just good investments. They are statistically rare, massive home runs. That tiny 7% generated essentially all of the 73-fold return for the entire index. Meanwhile, the remaining 93%, the other, 2,790 stocks, were either duds, mediocre performers, or those outright catastrophes we talked about.
And this kind of pummeling of most public companies, it happens across all industries, right? It's not just tech flaming out.
No industry is immune. More than half of all public tech and telecom companies lose most of their value and never recover. But even among public utilities, the ones we assume are super stable, boring dividend payers, the failure rate is still more than 1 in 10.
1 in 10 utilities fail catastrophically over time. Wow.
The key realization here is that these catastrophic losses aren't rare events that only happen to bad stock pickers. They are the normal background noise of a dynamic market. Remember, these are companies that achieved enough success to become public, to get into the Russell 3000.
And most still flame out. Their lifespans are measured in years, maybe a decade or two, not generations.
Right. And the ultimate cautionary tale here is maybe Corolco Pictures. Remember them?
Vaguely. They were big in the 80s and 90s.
Huge. They were a member of the Russell 3000. This wasn't some tiny, obscure firm. This studio produced massive blockbusters. The Rambo films, Terminator 2, Basic Instinct, Total Recall.
Okay, yeah, massive hits.
They went public, hit a $400 million market cap, $500 million in revenue in 1991. They were a titan for a moment,
Wow.
but the minute the tail events stopped, the blockbusters dried up, the company just crumbled. A few big budget projects flopped hard, the debt became unsustainable.
Yeah.
By 1996, Corolco was bankrupt. Stock went to zero, a catastrophic loss. But the sources remind us this kind of thing is experienced by 4 in 10 public companies over time. Corolco's story is worth telling not because it's some unique financial tragedy.
But because it's actually common.
Exactly, it's depressingly common.
So, just like Heinz Berggruen's art collection, where the few Picassos covered the cost of all the duds in the stock market, that 7% of index components that performed extremely well, the Walmarts, the Microsofts, the Apples over the years.
Yeah, the mega winner.
They were more than enough to offset that 40% failure rate. It's the few massive wins that define the market's return, not the consistent performance of the many mediocre ones or the drag from the losers.
Precisely. And this compounding effect, this tail dynamic, it doesn't stop at the company level either. Within those winning companies, you find even more dramatic internal tail events. This is where the long tail effect really compounds its power. It's like fractals.
Okay, give me an example. Let's look at the behemoths today. In 2018, Amazon alone drove 6% of the entire S&P 500's total returns.
6% from one company. Incredible.
But Amazon's staggering growth and valuation, it's almost entirely due to just 2 internal tail events, right? Prime and Amazon Web Services, AWS.
Absolutely. Prime changed retail. AWS created a whole new industry, cloud computing.
And this is a company that has famously experimented with hundreds, maybe thousands of products. Remember the Fire Phone?
Oh, yeah. A spectacular flop.
Right. Or they tried travel agencies, all sorts of things. Many failed completely or were just quietly abandoned. But Prime and AWS, those were the internal tails.
Similarly, Apple. In 2018, responsible for almost 7% of the index's returns. And that overwhelming success, even today, is driven predominantly by a single product line that just redefined the industry. The iPhone.
The iPhone. In the universe of consumer electronics, the iPhone is the ultimate tail product. A revolutionary winner that makes pretty much everything else the company does. iPods back in the day, accessories, even Mac computers pale in sheer financial comparison.
This realization that success within successful companies is also tail-driven, it leads some CEOs to adopt a mindset that's profoundly counterintuitive, especially compared to conventional corporate management, which usually aims for zero-defect production and predictable results.
Right. They have to actively embrace failure as a necessity, not just tolerate it, embrace it.
Jeff Bezos gave the perfect example of this. Shortly after the disastrous launch of the Fire Phone, a typical CEO would issue some carefully worded apology, promise greater efficiency, maybe fire someone.
Yeah, damage control.
Bezos did the opposite. He publicly stated, and I'm quoting loosely here, "If you think that's a big failure, we're working on much bigger failures right now. I am not kidding. Some of them are going to make the Fire Phone look like a tiny little blip."
It's an amazing quote. It sounds great on a stage, but how hard is that to actually execute within a company? It must take monumental ego strength, intellectual clarity to announce a failure and immediately promise a bigger one is coming. Why is this mindset so rare?
Well, think about career risk. Institutional pressure. Most managers, especially in big public companies with quarterly reporting demands, they're rewarded for efficiency, for avoiding errors, for predictable incremental gains.
Not for taking wild swings that might fail spectacularly.
Exactly. They are incentivized against those risky asymmetric bets. Bezos, however, understood the math. He knew the monumental losses from a failed product like the Fire Phone were completely insignificant compared to the tens of billions pouring in from AWS. He was operating on that Berggruen principle again. Buy in bulk, try lots of things, accept the failure rate, because the few winners will save the entire enterprise.
Netflix CEO Reed Hastings showed the same kind of clarity, didn't he? When he announced they were canceling several big budget productions. Instead of aiming for a flawless hit ratio, he said something like,
Yeah, he said, our hit ratio is way too high right now, which sounds crazy.
totally crazy.
He said, I'm always pushing the content team. We have to take more risk. We should have a higher cancel rate overall.
A higher cancel rate, aiming for more failures on purpose.
This is the operationalization of the long tail concept. It isn't irresponsibility. It's a really smart acknowledgement of how success is actually generated in creative, high-risk fields. For every Amazon Prime or every Orange is the New Black on Netflix.
You know with certainty that you must have duds like the Fire Phone or quickly canceled shows to find those disproportionate winners.
If you aren't canceling shows, if you aren't launching products that fail, you probably aren't taking big enough swings to ever hit that 50x tail event.
And it even goes deeper, down to the human element, you argue. The people working on these tail projects, the ones driving the tail returns, they often have what you might call tail careers.
Think about it. Consider the acceptance rates at these hyper-successful companies. Google's is reportedly around 0.2%, Facebook's maybe 0.1%, Apple's about 2%.
So getting hired there is itself a long-tail event.
Exactly. The individuals hired at these places, the engineers who built AWS, the designers behind the iPhone, they themselves are the result of an incredibly small, statistically outlying selection process. It's tails all the way down.
Okay, this is fascinating.
Yeah.
We've seen tails in art, film, VC, public stocks, even inside companies and careers.
Which brings us, I think, to maybe the most important tale of all for the individual listener, investor behavior.
The psychology.
Yes. We've established that the long tail determines the results of corporate America, the stock market, but it also fundamentally determines the outcome of your behavior as an individual investor.
This makes me think of Napoleon's fantastic definition of genius. Do you know what I mean?
Go on.
The man who can do the average thing when all those around him are going crazy.
Ah, yes. That perfectly captures the psychological challenge of investing, doesn't it?
It really does.
Because most financial advice, most commentary, it focuses on the now. What stock should you buy today? What does this week's economic report mean?
All right, the day-to-day noise.
But most of the time, today, it's not actually that important for your long-term results. Over the course of your lifetime as an investor, your total outcome will likely be determined by the decisions you make during a very small number of days. Probably 1% of the time, maybe even less. When everyone else around you is panicking, when markets are crashing, those few moments of sheer terror, they are the ultimate long tail of personal finance. How you act then matters more than almost everything else combined.
Okay, to make this brutally clear, let's revisit that thought experiment laid out in the sources. It compares 3 different investors.
Right. Saving just $1 a month, but doing it for a very long time.
For 1,428 months, actually. Spanning from 1900 all the way to 2019 into the U.S. stock market. Yeah. So this period covers everything. 2 world wars, the Great Depression, stagflation, the dot-com bust, the global financial crisis, all of it.
Okay, so investor number 1 is Sue. Sue is the paragon of consistency, the ideal, maybe unrealistic investor. She invests that $1 every single month, rain or shine, never sells. Doesn't matter if there's a recession, a bear market, a panic.
Buys when the news is good, buys when the news is terrible, just keeps her cool, dollar cost averages, maintains her exposure to the market's long-term upward drift, that upward tail.
Okay. Then we have Jim. Jim's the aspiring market timer. He tries to act on clear economic signals.
How does he do it?
He invests his dollar when there's no recession declared. But the second a recession is officially announced, he sells everything he's accumulated, puts his dollar a month into cash savings instead. And he only reinvests everything back into the stock market when the recession is officially declared over.
So he's trying to sidestep the downturns, avoid that 22% of the time the economy is officially in or near recession.
Exactly. Trying to be smart, avoid the pain. And finally, we have Tom. Tom represents maybe more typical lagging human psychological behavior, often driven by fear, headlines, emotion.
What does Tom do?
Tom sells 6 months after a recession begins. Once the pain is obvious, it's widespread, the news anchors are screaming, crisis!
He sells late, basically, when the damage is already done.
Right. And then crucially, he doesn't invest back in until 6 months after the recession has officially ended. He waits until he feels safe again, confident, until the all-clear sounds. He lags the market movements, driven by emotion.
Okay, Sue the steady adept, Jim the timer, Tom the panicker. The results? They're absolutely staggering, aren't they? And they just prove that the tale of behavior is way more powerful than the tale of economics.
Hit us with the numbers.
Sue, the consistent one, ended up with $435,551.
Wow. From $1 a month, compounding is amazing.
Jim, the attempt at market timing, finished with $257,386.
Okay, significantly less. Trying to be clever cost him nearly half.
And Tom, the panicker, the one who sold late and bought late, he ended up with just $234,476.
Ouch. Almost the same as Jim, maybe even slightly worse. Sue wins by a mile. She ends up with almost 3/4 more money than the other two.
How? How did she achieve that massive outperformance?
Simply by keeping her cool during those few painful moments. That 22% of the time the economy was in or near recession. The crucial moments for long-term wealth aren't the 78% of the time the market is grinding upwards or even drifting sideways.
It's those moments of volatility.
Exactly. When panic selling drives prices way down, often below intrinsic value, that creates the massive buying opportunity for the consistent investor like Sue. The compounding effect of simply remaining invested during those brief, often violent bounce backs from recessions. That's what creates the overwhelming long tail of Sue's wealth. She captured those recovery gains that Jim and Tom missed.
Let's zoom in on that psychological difficulty, though. If you sell during a dip, like Jim or Tom did, you actually have to be right twice, don't you?
That's the killer. You have to correctly time your exit, which is incredibly hard.
And then
you have to possess the monumental courage, the conviction to jump back in when the market feels the absolute worst, when every headline is screaming doom, when your neighbors are losing their jobs, when it feels that the world is ending.
And that second step is nearly impossible for most human beings.
Almost impossible. Fear and greed are the ultimate counterforces to consistency. To bring that home with a more recent example for listeners, how you behaved as an investor during just a few months in late 2008 and early 2009.
The depths of the financial crisis.
Yeah, that window of absolute terror. How you acted then likely had more impact on your lifetime returns than everything else you did patiently from, say, 2000 right up to 2008.
Like that old pilot quip, right? That their jobs are hours and hours of boredom, punctuated by moments of sheer terror.
Yeah, investing is exactly the same. Your long-term success isn't determined by your average performance during the boring years. It is almost entirely determined by how you respond to those few punctuated moments of terror, when everyone else, as Napoleon said, is going crazy.
Okay, the problem with internalizing all this data, all these stories, is that human nature makes this long-tail concept really hard to accept emotionally, doesn't it?
It really does.
We only see the winners. We see the Berggruen collection in a museum. We watch Snow White. We see Apple's stock chart going up and to the right. We use the iPhone.
We see the finished, polished success.
Yeah. We don't see the hundreds of failed art purchases, gathering dust, the bankrupt studios, the 40% of stocks that went to zero, the Fire Phone disaster. We don't see the failures that enabled the successes.
And that creates this psychological gap where our own inevitable professional failures or our investment losses, they feel like we're doing something fundamentally wrong. We compare our messy reality to the highlight reel of the masters.
So we need to normalize the failure, make it visible.
Exactly. And the world of stand-up comedy provides a perfect, maybe funny illustration of this hidden failure rate.
How so?
Think about Chris Rock. The Chris Rock you see on a Netflix special is hilarious, flawless, polished. He delivers this perfectly timed hour of brilliant material. Looks effortless.
Yeah, genius level.
But the sources reveal that the Chris Rock, who performs in dozens of small comedy clubs each year, testing out new material, well, he's quite often described as just okay, sometimes not even okay.
Really? Chris Rock bombing?
Well, maybe not bombing, but certainly working through stuff that doesn't land. That is the essential, unavoidable process. No comedic genius, not Rock, not Seinfeld, nobody, is smart enough to just sit down and write an hour of material they know will kill with millions of people.
They have to test it.
They must test their material in dozens of small clubs, performing for small, often forgiving audiences, refining it, cutting jokes, tweaking lines, before they ever use it in a massive arena or film a special.
Rock actually described preparing for a new tour by doing something like 40 or 50 shows at this tiny place in New Brunswick called the Stress Factory.
Yeah, workshopping it intensely.
And a newspaper profiled some of these sessions. They noted he was like fumbling with pages of notes, needing to cut jokes right in the middle of a skit, sometimes literally saying to the audience, okay, I'm going to have to cut some of these jokes. They're just not working.
Those fumbled jokes, the cut lines, the discarded bits. That is the 65% failure rate of comedy development. The polished, powerful, hilarious jokes we see on Netflix. Those are the perfect revenue-generating tales that stuck out from a universe of hundreds of failed attempts in small clubs.
So the secret to his genius isn't a flawless initial hit ratio.
Not at all. It's the willingness, the necessity to fail repeatedly in a controlled, low-stakes environment to find the winners.
A similar kind of illusion clouds our perception of investing legends too, right? Like Warren Buffett.
Absolutely. It's easy to find Buffett's net worth, his average annual returns for Berkshire Hathaway, his most famous investments like Coca-Cola or Apple. That stuff is public.
But it's much harder to piece together every single dud stock pick he made over 60 years. Or the ugly businesses Berkshire bought that didn't work out. Or the poor acquisitions. Those failures are the necessary other side of his tail-driven returns, but they're much less visible.
Although Buffett himself actually provided the ultimate clarity on this publicly at the 2013 Berkshire Hathaway shareholder meeting.
What did he say?
He stated, pretty matter-of-factly, that he'd owned between 400 and 500 different stocks during his life.
Okay, a lot of decisions.
But then he said he made most of his money on only 10 of them.
10 out of 400 or 500?
Yeah, that level of concentration, maybe 2% of his investment decisions, generating the vast majority of his legendary wealth, it perfectly reveals the absolute power of the tail, even for arguably the greatest investor in history.
And his partner, Charlie Munger, drove the point home even harder, didn't he? With that killer synthesis.
Munger said if you remove just a few of Berkshire's top investments, its long-term track record is pretty average.
Pretty average. Their entire legendary success came down to a handful of spectacular tail-driven decisions, not consistent brilliance across 500 different stocks.
It brings us back to Peter Lynch, the famous Fidelity manager. He understood this necessity for failure perfectly. He used to say, if you're terrific in this business, you're right 6 times out of 10.
Just 6 out of 10. Slightly better than a coin flip.
Exactly. Investing is simply not like flying a plane or being a brain surgeon or even being a chef in a top restaurant where you have to strive for 99.9% perfection all the time.
The stakes are catastrophic in those fields.
Right. In investing, being slightly better than 50-50 can make you a legend, provided your winners are massive enough to more than cover all your inevitable losses.
Which brings us, I guess, to George Soros's ultimate summary of this whole principle.
Yeah, Soros put it bluntly. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong.
It's the magnitude, not the frequency. You can afford to be wrong more than half the time. Accept that failure rate as normal, maybe even necessary, and still make a fortune.
So what does this all mean for you, the listener? I think the crucial insight we've uncovered today, looking across all these different fields, is the necessity to accept that failure. Well, it's the normal, maybe even the required prerequisite for outlier success.
Right. Stop beating yourself up for the losses.
Exactly. When you truly acknowledge that tails drive pretty much everything from Disney's success to the entire Russell 3000's performance over decades to Buffett's record, you can start to stop overreacting to the inevitable losses in your own portfolio, or the setbacks in your business experiments, or the failures in your career path.
Being wrong half the time, maybe even most of the time, and still making a fortune. It's not a contradiction.
It's not a contradiction at all. It is simply math. It's the math of asymmetric returns, compounding, and crucially the math that rewards volume of attempts, time in the game, and perhaps most importantly, emotional control during those rare moments of crisis.
And here is the final provocative thought we want to leave you with from this deep dive. Something to maybe mull over. The longest tail of all might just be existence itself.
Go on.
If we accept the near zero probability of intelligent life emerging. The source material kind of reminds us There may be 100 billion planets just in our galaxy alone.
An unimaginable number.
And only one, as far as we currently know, has intelligent life capable of having this conversation. So the fact that any of us exist at all, that we're here to analyze stock market data or worry about VC returns, that itself is the result of a single, spectacular, statistically almost impossible outlying event.
That certainly puts things in perspective. It's the ultimate long tail.
Right. So this framework, maybe it should put the normal failure rate of stocks, that 40% or the 65% failure rate in venture capital, into a necessary, maybe even refreshing perspective.
If the most important outcome we know, our very existence, is the result of the longest tail you can possibly imagine,
Then expecting a 40% failure rate in the stock market, or a 65% failure rate in VC deals, or having your startup idea not work out, it's not some kind of cosmic tragedy.
no, it's just background noise. It's the expected cost of participating in systems driven by tails. Your job, then, isn't necessarily to avoid failure.
It's to ensure you have consistent exposure over the long run to the tiny probability of the spectacular win, and the discipline to stick around long enough for the tail to potentially find